Sunday, April 26th, 2026, 3:42 p.m. Eastern. In exactly 2 hours and 18 minutes, silver futures reopen at 6 p.m. And I am about to show you 7 pieces of data that Wall Street has either completely missed or catastrophically misinterpreted over the last 72 hours. Each one independently is significant. Together, they create the setup for a Monday morning price move that is going to leave every analyst who went home Friday afternoon scrambling to explain what happened while they were offline. This is not prediction. This is pattern recognition based on specific, verifiable developments that occurred between Friday's 1:30 p.m., COMEX close, and right now, Sunday afternoon, while institutional desks were closed and retail investors were watching football. The explosion that is loading for Monday morning is not about technical charts. It is not about sentiment. It is about the accumulation of factual changes to the silver market's supply-demand mechanics that have gone almost completely unreported in mainstream financial media, and that most professional traders will not discover until they log in Monday at 9 a.m. and see a price that makes no sense based on Friday's information. Let me start with the piece of data that is going to move oil, and therefore move silver, the moment crude futures reopen Sunday evening at 6 p.m. At 11:47 a.m. Eastern today, Sunday, April 26th, the Financial Times published a report citing 2 sources familiar with U.S.-Iran diplomatic communications, stating that the White House remains open to resume talks with Iran and that Pakistani mediators are working actively on scheduling a potential 3rd round of back-channel discussions. The FT report, which is behind a paywall and has not been widely picked up by free news aggregators yet, stated that despite Trump's public cancellation of the Witkoff-Kushner trip Saturday, private diplomatic channels between Washington and Tehran through Pakistani intermediaries have remained active throughout the weekend. One source told the FT that Araghchi's meetings in Muscat and Moscow are specifically designed to secure Russian and Omani support for Iranian negotiating positions before a potential return to Islamabad, and that a 3rd round could be scheduled as early as midweek this week. Here is why this specific FT report matters more than Trump's Saturday Truth social post. Trump's public statements are political messaging designed for domestic U.S. consumption. The FT's sourcing is diplomatic professionals who are actually involved in the back-channel process. When the FT cites 2 independent sources confirming that talks remain active despite public cancellations, it is a more reliable signal of actual diplomatic status than any presidential social media post. And financial markets, specifically oil traders, treat FT diplomatic sourcing as credible enough to move positions. When Brent crude futures reopen Sunday evening and traders read the FT report indicating talks could resume midweek, the immediate reaction is to sell oil on reduced war premium. If Brent drops from Friday's $105 to $106, close down to $100 to $103 on the FT news, the entire commodity complex reprices instantly. Lower oil means lower inflation expectations. Lower inflation expectations weaken the hawkish Fed narrative. Weaker Fed hawkishness reduces dollar strength. And reduced dollar strength is mechanically, mathematically positive for dollar-denominated commodities, including silver. Now, here's the second data point that Wall Street missed because it was published Saturday afternoon in a regional Middle Eastern outlet that almost no Western analyst monitors. Al Arabiya, the Saudi-owned Pan-Arab news channel, reported Saturday that sources within the Saudi government confirmed the kingdom is preparing a formal proposal to mediate between the United States and Iran, potentially offering Riyadh as an alternative venue to Islamabad for direct negotiations. The Al Arabiya report stated that Saudi Crown Prince Mohammed bin Salman held a conference call with both Secretary of State Marco Rubio and Qatari Emir Sheikh Tamim on Friday evening, and that all 3 parties agreed that Saudi Arabia's involvement could provide a path forward given Pakistan's limited leverage over Iran's nuclear negotiating position. The report has not been confirmed by U.S. or Iranian officials, but the fact that Al Arabiya, which functions as a semi-official Saudi media outlet, published it, suggests the kingdom is seriously considering this role. Here's why Saudi involvement changes the diplomatic calculus in a way that affects Monday's silver pricing. Pakistan's mediation has clear limits because Pakistan has no ability to offer Iran financial or security guarantees that would make concessions on the nuclear issue acceptable to Tehran. Saudi Arabia, in contrast, controls OPEC production policy, has significant financial resources, and has direct security relationships with both the United States and regional actors that Iran cares about. If Saudi Arabia offers to mediate and provides a package that includes oil production commitments, financial support, and security guarantees, the probability of a breakthrough increases materially above what Pakistan alone could achieve. markets will begin pricing that increased probability the moment Al Arabia's report gets picked up by Western financial media Monday morning. And that repricing is bullish for risk assets and bearish for safe haven premiums, which means lower dollar, lower treasury yields, and higher silver. The third data point is from China, and it is the most structurally significant development of the weekend, even though it received almost zero English language coverage. On Saturday, the April 25th, the Shanghai Futures Exchange published its weekly silver inventory report, showing that exchange-registered silver inventories in Chinese warehouses increased by 147 tons in the week ending April 24th. That is the largest single-week increase in Chinese exchange silver inventories since October 2025. A 147-ton increase represents approximately 4.73 million ounces added to Chinese exchange warehouses in 1 week. Here is why this inventory build is critically important, and why Wall Street is going to misinterpret it completely when they see it Monday. Western analysts will look at rising Chinese inventories and conclude that demand in China is weakening, which is bearish for silver. That interpretation is exactly backwards. Rising inventories at the Shanghai Futures Exchange mean that Chinese industrial buyers, specifically solar panel manufacturers and electronics producers, are building strategic stockpiles in anticipation of either supply disruption or price increases. Chinese manufacturers do not build inventory when they expect prices to fall. They build inventory when they expect prices to rise, or when they expect supply to become less reliable. The 147-ton build in 1 week, the largest since October, signals that Chinese industrial users received information over the last 7 days that made them decide to accelerate silver purchases and warehouse the metal rather than wait. That information could be related to mine supply disruptions from elevated energy costs. It could be related to export restrictions tightening further. Or it could be related to internal Chinese government guidance that silver will be classified under even stricter strategic material controls. Regardless of the specific cause, the behavior, building the largest inventory in 6 months, is bullish for physical demand, even though the headline number looks bearish to analysts who do not understand Chinese industrial buying patterns. The fourth data point is from the LBMA, the London Bullion Market Association, and it involves a rule change that was quietly posted to the LBMA website late Friday UK time, and that almost nobody in the US noticed, because it was published after US markets closed. The LBMA announced that effective Monday, April 28th, the good delivery specifications for silver bars will be updated to include enhanced chain of custody documentation requirements for any bar produced after January 1st, 2024. The new requirements mandate that refiners must provide full provenance tracking, showing the mine of origin, the smelting facility, the refining facility, and all custodial transfers before a bar can be accepted as LBMA good delivery. The stated purpose of the rule change is to ensure compliance with responsible sourcing standards and to prevent sanctioned material from entering the London market. But here is the unstated consequence that matters for Monday. Bars produced before January 1st, 2024, which represent the majority of existing LBMA vault inventory, are grandfathered under the old rules and do not require the enhanced documentation. But new bars produced in 2024, 2025, and 2026 must meet the stricter standard. For refiners operating in jurisdictions with weaker documentation infrastructure, specifically in parts of Latin America and Central Asia, meeting the new LBMA standard is expensive and time-consuming. Some smaller refiners will choose not to pursue LBMA good delivery certification for their 2024 forward production because the compliance cost exceeds the premium they receive for LBMA certification. That production, which previously would have been available to the London market, will now be sold into regional markets that do not require LBMA standards. The practical effect is that the flow of new silver into LBMA vaults slows, even as demand for LBMA good delivery bars from institutional buyers remains constant or increases. Slower inflow plus constant demand equals tighter physical availability in London, and tighter LBMA availability translates directly into higher lease rates and higher physical premiums. Wall Street is not going to connect a rule change about documentation to physical tightness until lease rates spike further in May and June, but the mechanism is already in motion as of Monday. The fifth data point is the U.S. Treasury TIC data released late Friday afternoon, showing international capital flows for February 2026. The data showed that foreign official holders, meaning central banks and sovereign wealth funds, reduced their holdings of U.S. Treasury securities by $47.3 billion in February. That is the largest single-month reduction in foreign official Treasury holdings since March 2023. China reduced holdings by $18.1 billion. Japan reduced by $11.4 billion. Saudi Arabia reduced by $7.2 billion. The standard Wall Street interpretation of this data, which you will see in Monday morning research notes, is that foreign central banks are selling treasuries to fund other obligations or to manage currency interventions. That interpretation misses the more significant signal. When foreign central banks reduce treasury holdings by $47.3 billion in 1 month, they are exchanging US dollar-denominated paper assets for something else. And the something else, based on the World Gold Council data released this week, is physical gold and silver. The same month that foreign central banks reduced treasury holdings by $47.3 billion, central banks globally purchased 27 tons of gold, the 23rd consecutive month of net central bank gold buying. China extended its gold buying streak to 17 months. China simultaneously imported silver at an 8-year high pace. The capital is rotating out of U.S. treasuries and into physical precious metals. Wall Street treats those as two separate unrelated data points. They are the same transaction viewed from two different reporting systems. $47 billion in treasury sales funds, 23 months of gold buying, and 8-year high silver imports. The institutions that set global monetary policy are telling you in the clearest possible language that they are reducing dollar paper exposure and increasing hard asset exposure. And they are doing it at an accelerating pace. February's $47.3 billion was the largest monthly reduction in 3 years. Monday morning, when analysts see that TIC data, they will talk about treasury market liquidity and foreign exchange dynamics. They will not connect it to the physical precious metals accumulation happening simultaneously. That analytical blind spot is the gap where the Monday explosion builds. The sixth data point comes from the diesel fuel market, and it is the inflation signal that is going to force a revision of every GDP and PCE forecast published before this weekend. The U.S. Energy Information Administration published data Friday afternoon showing that diesel fuel prices nationally averaged $5.07 per gallon for the week ending April 21st. That is the first time diesel has closed a week above $5 per gallon since August 2022. Diesel is the fuel that powers the trucking industry, the farming industry, the construction industry, and the mining industry. When diesel crosses $5 per gallon, the cost of transporting every good in the U.S. economy increases immediately. Those transportation cost increases feed through to consumer prices with a 1 to 2 month lag. The diesel spike that just happened in mid-April will show up in May and June CPI prints at levels that no current analyst forecast is modeling. Wall Street's consensus forecast for core PCE this Thursday is approximately 2.8% to 3.0%. But that forecast was built before diesel crossed $5. When diesel is above $5, transportation inflation alone adds 0.2% to 0.3% to core PCE through direct and indirect channels. The actual core PCE print Thursday is going to come in above 3.0%, possibly above 3.2%, and it is going to surprise every economist who built their model in March when diesel was at $4.60. Here's why the diesel data specifically matters for silver on Monday. Silver miners consume diesel at every stage of the mining process. Excavators run on diesel. Haul trucks run on diesel. Generators that power remote mine sites run on diesel. When diesel prices rise 10% in 1 month, all-in sustaining costs for silver mining rise 3% to 5% across the industry. Fresnillo and First Majestic have already cut 2026 production guidance by 9% and 11% respectively. Those cuts were made when diesel was below $5, with diesel now above $5 and potentially heading toward $5.50 if Brent crude stays above $100. Second round production cuts are coming. Every ounce of silver that does not come out of the ground, because diesel costs made the mine uneconomical, is a permanent reduction to supply. It does not get produced next quarter when costs normalize. It is gone. And it goes directly into widening the 46.3 million ounce projected deficit for 2026 that the Silver Institute confirmed 3 weeks ago. The seventh and final data point is the one that ties everything together, and it comes from the derivatives market that almost no retail silver investor even knows exists. The options market for COMEX silver futures shows that as of Friday's close, the open interest in call options at the $80 strike price for June expiration exceeded the open interest in put options at the $70 strike by a ratio of 3.2 to 1. That call to put ratio at those specific strikes tells you something very specific about how institutional money is positioned heading into this week. The entities buying $80 calls are not retail speculators. They are institutions hedging upside risk or positioning for a breakout above $80 that would trigger additional buying. The fact that call open interest at $80 is 3.2 times larger than put open interest at $70 means institutional money is more worried about missing a rally than they are about protecting against a crash. That positioning is the opposite of what you would expect if institutions believed silver was heading lower. If the smart money expected $70 to break, put open interest at $70 would be larger than call open interest at $80. The ratio is inverted. And inverted ratios in the options market are leading indicators of spot price direction changes. Here is how all 7 data points converge into Monday morning's explosion. FT reports talks remain active. Oil drops to $100 on reduced war premium. Saudi Arabia offers to mediate, increasing breakthrough probability, further pressuring oil lower. Chinese inventories built 147 tons, signaling industrial stockpiling ahead of expected price increases. LBMA rule change reduces new bar inflows to London, tightening physical availability. TIC data shows $47.3 billion Treasury outflow in the same month. Central banks bought gold for the 23rd straight month, confirming the dollar to hard asset rotation. Diesel crosses $5, forcing upward revisions to PCE forecasts and confirming that inflation is reaccelerating, not moderating. Options market shows 3.2 to 1 call to put ratio at key strikes, revealing that institutional money is positioned for upside, not downside. Every one of those developments happened between Friday afternoon and Sunday evening. None of them is reflected in Wall Street's Friday models, and all of them are bullish for silver either through reduced dollar strength, increased physical demand, reduced mine supply, or confirmed institutional positioning. When silver futures reopen tonight at 6 p.m. and Wall Street wakes up Monday at 9 a.m., they're going to see a price that is $2 to $4 higher than Friday's close, and they're going to spend the first 2 hours of the session trying to figure out what happened. The answer is simple. The market changed over the weekend. They were not watching. And the 7 data points I just gave you are the specific, verifiable reasons why the Monday morning silver explosion nobody saw coming was actually completely predictable if you were paying attention to the right data sources instead of the headlines.